Good afternoon. There's a lot of talk right now out in the market about has our market peaked? Are we in a housing bubble? And today's topic of discussion is gonna point out everything to show why I believe we are not in a housing bubble. The market has started to peak and we're in a stabilization phase. So we've got 4 points that I'm going to go over quickly to lead me and hopefully you to believe that we're stabilizing and we're not in a bubble. I'm Dale Snyder with the Snyder Group, Team Focused Real Estate here in Las Vegas, Nevada. Let's jump right in. Shazam! Here we go. Video magic, baby. So K. Schiller, real quickly. It's a 20-city composite where they study the historical data and come up with the research that indicates the direction we're heading. So this is really going to be a 20,000-foot view looking down on the forest here, so to speak. So we're going to have this at the end of the video. If you'd like to have a copy of it, reach out to me if you'd like to discuss it further. So let's look at, let's go down memory lane here. So this is money, this is time, and this here is the historic trend line of home appreciation. It's about 3 to 5% a year. It's paired with inflation. So let's look at memory lane here in Las Vegas. Here we go along the trend line. All right, so there's the bubble, right? This is when the market bubbled way above the trend line and then we crashed, right? So we're right about here today, which is between, 30 to 35%. I think valley-wide as a whole, the most recent data is we're up 26%. So the most important thing here from this K. Schiller information is we are still about 20% below the historic trend line of where pricing should be in our marketplace. So we've got a ways to go before we even hit that mark. In fact, we are the furthest under the K. Schiller trend line out of the entire 20-city composite. The other thing that's important to note here is the snapback. I projected this, many people felt this and believed it, that when we came crashing down so hard, we were way below the replacement cost of a home, and the buyers pulled out and got onto the sideline and stopped buying, that at some point we were gonna see a snapback of pricing, of which we've seen. We've snapped back about 20, 35% in 18 months or so, which we expected, not uncommon. So that's point one with the K. Schiller index in the snapback. All right, so now let's move on to point two with inventory leading us into a stabilization period. So once again, if you take a look at this here, this shows historically where inventory levels should be in a stable market. You'll see a 5 to 6 month supply to be even. That's a normal market. It's not controlled by the sellers, not controlled by the buyers. So at this point, our inventory is going up drastically in the valley. Don't be alarmed by that. We need that to get to our stabilization point. I think we had about 3,500 units on the market earlier in the year. We're at about 6,900 as of today, but we're selling about 3,100 a month right now. And I've averaged this out for the last 2 years, and we average about 3,300, 3,400 sales per month through the MLS. If you multiply that by 5, that puts us at about 16,000, 17,000 units on the market. So we can see a big increase in our inventory levels still before it's going to turn us heavily into the buyer's favor. So don't be alarmed by increasing inventories. And then price reductions. Don't be alarmed by price reductions, because here's what's happening. Sellers are coming onto the market and trying to push the market another 10%, 15% over the 30 we've already gained. As we go into our winter season and as we see inventory increase, we're going to start to see price reductions where these people that need to sell are going to start aligning their pricing with the comparable sales, and some of them may be a bit below. So don't be alarmed by that. That is going to come, and that's healthy for our market. Point 3, the affordability. This is critical. Let's start by looking at the affordability index. So by this graph that you see here, what we've done, or what they have done, the data here, and just reach out to us if you'd like a copy of this and the references of where this data is coming from, because it's very reliable sources of educated economists that study this data. So it's based on average income and based on average price point, and then about a 30-35% of the average household income being delegated towards housing. You will see that the trend line, the 100% mark, Vegas is in light blue. We are still far below the affordability threshold. So we got a ways to go. Interest rates were to go up or prices were to go up, we can still sustain that based on the income level here in Las Vegas. If you go to the next slide, you will see this is the rent versus own. It is still much cheaper to own than it is to rent. The great thing about this is we are the lowest in the index of the 20-city composite for both affordability and rent versus own. So prices could come up quite a bit, rates could come up a bit, and it's still going to be cheaper to own than it is to rent. That's a very important point. Point 4, current buyer profile. Over 50% of the buyers are currently paying cash. The remainder are almost getting a full cavity search. Any of you that have had to qualify for a loan know that it's no joke in today's market. So the ownership of buyers are very strong. So if we were to see a downturn, which we could, what, market drops 5-10%? I mean, some of these people are priced 10-15% above the market. So if they were to drop 20% off their list price, that would put us into market range. That doesn't mean we're in a bubble and it's busting. It's reality. So that's a very important point to know, that we have a very strong profile of buyers. So, in summary, we discussed the Case-Shiller Index and why the prices snapped back as strong as they could, and that was normal. That we're heading into a stabilization period with our inventory. Don't be alarmed by price reductions, because it's going to align people back to reality, or they're going to take their homes off the market. Affordability. We're the most affordable city to buy in. I mean, that's a strong, strong point. And then the profile of our current buyers. Let's get real here for a minute. I can go into great detail about the quantitative easing and Bernanke pumping money in, and all these other factors which are going to impact our market. If we're going to I don't want to get too convoluted and complicated here. I'm just looking at the key points in the data, and then you can analyze that data and decide what's the best play for you in this current market. Feel free to reach out to me. I'd love to have an educated conversation with you about it, because it depends on, are you selling, buying, investing, and your timeline, the product you have, and the location in the valley is all going to dictate what I would advise you to do. I know you might be thinking of a couple other things about shadow inventory and the investors pulling out of the market and the hedge funds. We're not covering that in this video, but if you do catch this video here, we discuss that in detail. Hope this information was of value. You might have caught our Summerlin West market update, which covered a lot of this because that market's mirroring the Las Vegas Valley as a whole. It's Dale Snyder with the Snyder Group, Team Focused Real Estate. If you like the video, like it, share it with your friends. Have an awesome day. Thanks for your time.